Hey YouTube, welcome back to the CSPreneur. Today we're going to be talking about how to identify 6 bullish candlestick chart patterns. In the last video I talked a bit about what a candlestick chart is, so if you haven't already watched that, I'm just going to link that in the description below. Make sure to go and watch that and you'll be set for this video. So today we're going to be covering the bullish engulfing pattern, the dragonfly doji, the hammer, the Morningstar, the piercing pattern, and the 3 soldiers. So I'll leave timestamps in the description below to each one of these patterns. Firstly, let's start out with the bullish engulfing pattern. This pattern forms when a small red candlestick, indicating a bearish trend, is followed by a large green candlestick, indicating that the bulls have taken control. When you're identifying this pattern, make sure that the small red candlestick is engulfed completely by the large green candlestick. So notice in the image that I've put up how the small red candlestick is completely engulfed by the large green candlestick. Engulfed means that the stock has to open lower than the previous day closed and close higher than the previous day open. So this large green candlestick means that the bulls have again taken control of the market. So you should be expecting a large bullish market trend, but again, make sure that you use multiple studies when choosing to invest. Here are some 3 key things to remember when identifying this pattern. There has to be a preceding downtrend, which means that the market should start high and slowly start dipping, and you should see this pattern at the low. The stock must open at a lower price on day 2 than it closed on day 1. Again, the green candle needs to completely engulf the red candle. Here are 3 things to remember when trading the pattern. Look for the bottoms of continuous downtrends. As soon as you are confident that there's a trend reversal, place a buy option on that stock. But make sure to invest wisely and place a stop loss below the green candle to avoid any further loss of money. Take a look at this chart that I put behind me and see if you can try and identify the bullish engulfing pattern. Next is the dragonfly doji. The dragonfly doji is a typical bullish reversal pattern found at the bottom of downtrends. It is super easy to recognize and is pretty reliable. This pattern is created when the open, high, and close prices are about the same. The most important sign of this trend is the long lower shadow. This shadow, or the bottom of the candlestick wick, indicates that there has been a test of the market and the bulls have taken over. This pattern is very similar to the hammer pattern, which will be coming up soon. Here are 3 things to remember when identifying the dragonfly doji pattern. The dragonfly doji pattern must have a long lower shadow or candlestick wick. The open and close prices need to be nearly the same. Finally, there should be little to no upper shadow. Here are 3 things to remember when trading the pattern. Again, look for the bottoms of continuous downtrends. Place a buy on confirmation of trend reversal. And finally, make sure to put other indicators to work. This will help you identify the bottoms of downtrends. Look at the chart that I've put up behind me. Can you identify where the dragonfly doji pattern occurs? Next up, the hammer. Again, as previously mentioned, this is extremely similar to the dragonfly doji pattern. As you can see from the picture, the candle looked very similar to a hammer. This pattern has a long lower wick or shadow and has a very small body. Here are 3 things to remember when identifying the hammer pattern. The hammer must have a long lower shadow. The lower wick needs to be 2 times greater than the length of the body. The color of the candle does not matter, and there should be little to no upper shadow. Here are 3 things to remember when trading the pattern. Look for hammers in downtrends. Be cautious and wait for confirmation. The hammer could just be another candlestick. And finally, put other indicators to work. This will help you identify the bottom of a current downtrend. Let's move on to the Morningstar. The Morningstar is yet again a bullish trend following a downtrend. This pattern consists of 3 candlesticks. The first is a red candlestick, indicating a downtrend. The second bar can be red or green, but needs to close below the first bar. And there also needs to be a gap, as seen in the picture. The third bar needs to be green and forms a gap by opening above the second bar. Here's the logic behind this pattern. The first large bearish candle indicates a wave of sells. The middle doji candle represents an indecision in the market. Finally, the long bullish candle represents buyers taking control of the market. We will discuss this a little more when we talk about volume later on in the course. Here are 2 things to remember when identifying this pattern. The Morningstar can be difficult to locate, but is definitely a strong reversal pattern. Again, this pattern must consist of 3 candles and must form gaps. Here's some things to look out for when trading this pattern. Look for volume. Traders don't usually wait for confirmation on the 3rd candle, so they buy early and inflate the volume. High volumes on the 3rd candle will confirm the pattern. The larger the 3rd candle, and the higher it moves in relation to the red candle, the larger the potential trend reversal. Check out this chart I've put up and see if you can identify the pattern. If not, I've circled it. Let's move on to the piercing pattern. The piercing pattern is a set of 2 candles. One candle is bearish and the other is bullish. The piercing pattern occurs when the bullish candle closes above the middle 50% of the preceding bearish candle. Although still a bullish pattern, it isn't as easy to spot as the bullish engulfing pattern that we talked about earlier. It is also slightly less unreliable than the bullish engulfing pattern. Here are 2 things to remember when identifying the piercing pattern. There has to be a downtrend prior to this pattern. The green candle on day 2 opens with a gap and closes above the middle of the preceding red candle. Here are 2 things to look out for when trading the pattern. Look for a potential bottom in a downtrend where this pattern may form. Second, wait for the closing of the 2nd candle before being sure that this pattern has formed. You should also place a stop loss below the green candle to make sure that you don't lose any more money. Check out this chart that I put up and see if you can identify the pattern. If not, I've circled it. Finally, our 6th pattern is called the 3 soldiers. The 3 soldiers consist of 3 long bullish candlesticks. They signalize a strong change in the market with the bulls taking over. Here are 2 things to remember when identifying the 3 soldiers pattern. There should be a downtrend prior to this pattern, and there very possibly can also be another reversal pattern that we have identified. The 3 candles should not have very long shadows or wicks. Make sure to keep this in mind when trading the 3 soldiers pattern. The big move could temporarily reach RSI overbought levels. They could also reach major resistance levels. Don't worry if you don't understand what these mean, as we will cover these later. For these reasons, make sure to look out for other trend reversal patterns before making any conclusive decisions. Check out the charts that I've put up behind me. See if you can identify the 3 soldiers pattern. If not, I've circled it for you. Alright guys, that pretty much wraps it up for this video. Let me know what you think in the comments below. Make sure to hit that like button and that subscribe button if you haven't already, as there are going to be more and more great videos for beginner investing coming up soon on the CSPreneur. And I look forward to seeing you in the next video.